Sasa International Holdings, Hong Kong's largest listed cosmetics retailer, reported a 20% rise in fiscal full-year profit as an economic recovery and wages increases in China boosted local consumption and spending outside China. For more on the company's outlook, Sasa International Holdings CFO Guy Look joins us for more from Hong Kong this morning. Profit looking pretty good, Guy. For the year ended March, up 20%. Do you see better numbers in the coming quarters given expectations of higher economic growth?
Well, we're looking for growth in different areas. I think, first of all, in Hong Kong, we are seeing a pickup in growth rate because we have seen a very strong momentum moving forward as from the beginning of this year with stronger spending by consumers in general. So basically consumer sentiment has improved despite what we might think as uncertainty in the market. So that's very positive for us in Hong Kong. We have also seen very positive numbers in Singapore. So I think for Hong Kong and Singapore being more open economy, I think we have been more reactive positively to the recent improvements in the markets. And in the China market, of course, it's a very big market.
Why isn't China one of your main markets, if not the main market for Sasa?
Well, it's gradually becoming. In Hong Kong, more than half our business now is conducted by selling to mainland Chinese. And our recent numbers actually tell us that if we add up the Hong Kong sales to mainland Chinese together with our direct sales to mainland Chinese in China, together with our online business, two-thirds of which are being sold into China, nearly 50%, in fact, 49.8% of our sales are sold to mainland Chinese, whether directly in mainland China or outside of mainland China. And of course, at this stage, we don't yet have that many stores in mainland China, and we are very, very positive about the China market. That's why we hired a new non-executive director to help us formulate a long-term strategy for the China market. And this is underway. And with this long-term strategy, we really hope to really build up our mainland China business. And we're investing all the right resources in the China market, including human resources and also CapEx.
You mentioned that you're banking on Hong Kong. Are rising rents in Hong Kong eating into your margins?
It has a little bit this year. I think it is generally the case that in a strong market, the rental tends to be quite tough. And in our case, for this year, we've had 2 flagship stores with very high increment for us, and that's averaged up the whole portfolio's average increment. But that's quite unusual in this particular year because we've just had one lease with a 5-year old term, which had to be renewed, and obviously that represents a very steep rise for us. But moving forward, we see, as I've said, stronger growth in Hong Kong, and we're also seeing stronger growth in terms of sales mix for our higher margin products, which is starting to take place in this current financial year, and for the first quarter is looking very, very positive. So in that respect, with a stronger growth in Hong Kong and with a positive sales mix in favor of high margin products, we're really quite positive.
How will the change in the yuan policy impact your company's operations?
Well, I think together with the recent wave of pay rises in China, the renminbi and the pay rises both serve to enhance the purchasing power of the mainland Chinese, both within China and outside of China, and also their online spending. But in the case of renminbi, I think has an added effect in our case, which is really the import prices, because we have a business in China. Yes.
Guy Look, Sasa International CFO, thank you.